Hello everyone, I'm Christian Lundblad, the Levin Distinguished Professor of Finance at the Kenan-Flagler Business School at the University of North Carolina and the Director of Research at the Kenan Institute of Private Enterprise. And I thought I would share with you, given recent events, some commentary with respect to Federal Reserve policy and a little bit of the world's pervasiveness of negative interest rates. So the Fed has recently met, as I'm sure everyone is aware, and been sort of consistently switching its policy direction in the direction of a greater degree of stimulus or easing. And that's generated some confusion, some debate, and I think there is even some disagreement between the messaging that's coming from the Federal Reserve with, for example, its so-called dot plot, where they sort of convey to market participants where they think policy is going with respect to what market participants are expressing in their own financial prices in places like, for example, the Fed funds futures market, which consistently disagree with the Fed's own messaging about the direction of policy. And I think what's quite interesting over here is the pervasiveness, along with commentary from the ECB and the Bank of Japan, and indeed even recent moves from some of those monetary authorities about the extent to which actual negative interest rates are finding their way all around the world. And indeed some questions about whether we might find that over here in the United States with the Fed moving sharply in this reverse course. So let's talk a little bit about what negative interest rates really are and then kind of my view on what the policy looks like. So negative interest rates mean a number of different things. Certainly central banks around the world charge commercial banks for the reserves that they hold in a way that is consistent with the negative rate. So you're actually paying to park your money with the central bank as opposed to being paid. That's one small piece. Another piece is there are actually some deposit-taking institutions that charge their customers to put their money in there as a savings account. That's not particularly common, but that does exist to some degree. These are technically negative interest rates, and this is not exactly what I want to talk about, however. The largest component of this is actually in the bond market. So this is the extent to which governments and firms are raising capital in a public issue, and we're talking about something on the order of $17 trillion collectively around the world. Now these are in currencies other than our own here in the United States, but if we kind of put in an apples-to-apples comparison, we're talking about 17 trillion, which is pretty sizable in a bond market that's around $100 trillion, give or take, when you add everything up. So what is this? This is largely government bonds, particularly in Europe, in euros, as well as in Japan, in yen. There are, however, some corporates, so some actual private enterprises that are raising debt financing in this way with a negative interest rate, which really ought to give you pause. It's kind of odd to think that they're actually being paid to borrow money. And then secondly, the vast majority of this, as I alluded to, are in euros and yen. So this is not really about dollar issues. This is simply a statement that the price that market participants are paying for bonds exceeds the present value of all of the cash flows associated with those bonds. So essentially, you're baking in a negative return. That's what we mean by a negative yield or a negative interest rate over here. And the question that's happening now as the Federal Reserve is turning corner is, could this happen here? Could we actually move into a negative interest rate state or a negative bond yield state in the United States? And my answer is likely no, but I actually don't think that's quite the right question. I think the right question is, here in the United States, as you see all around the world, they're just phenomenally low interest rates. And whether they actually pierce the zero boundary or not, I'm not sure is quite what we're after. And I think it's entirely appropriate right now, given where we are in terms of the economic cycle, in terms of global trade reductions, in terms of political uncertainty and all the risks that are kind of associated with that, it would be normally appropriate for the Federal Reserve or those that follow the Fed, economists, market participants, and academics, to sort of talk about the reasonableness, given the Fed's dual mandate of tackling inflationary concerns and maximal employment concerns, to say there may be a reason to cut interest rates at present. I think it's appropriate to ask that question, but that's in a normal setting. And here's the reality, which is we're not in a normal setting. We are still in a highly unorthodox monetary policy environment all around the world, including here at home. So we have, for the better part of 10 years, been engaging in unconventional, unorthodox monetary policy. I mean, my undergraduate students were children when this started. It's been going on forever. So in a borrowing culture like ours here in the United States, where we pervasively spend beyond our means, The question is, are we addicted to low interest rates? And whether they're technically negative or not is not really the issue. I mean, are central banks in some sense caught in a loop of their own making? From 2015, we here in the United States were starting to reverse course and raise interest rates, but now that's clearly finished. And the other industrialized countries have made no such moves along the way. But the issue is, what are the medium to long run consequences of this kind of behavior? I mean, the reality is this: we have zero idea what that implication is going to be. Negative interest rates, in particular, sure, they can create all kinds of odd distortions, but so too can pervasive, long-run, low interest rates also create a misallocation of resources. So let's talk a little bit about the intended effects and the unintended effects of low or negative interest rates. The intended effects are relatively straightforward. The central bank there is trying to reduce borrowing costs, or even kind of create a payment, as it were, for households, firms, governments to engage in economic activity that they otherwise would not have in the absence of that low interest rate environment. So now are firms going to take on debt to finance a project, or households going to buy a durable good that they otherwise wouldn't have? That's the intended effect of this kind of behavior. The unintended consequences, however, are murkier, right? So the issue in kind of weighing these two trade-offs, we have to think carefully about what those unintended consequences are. So number one, financial markets may get overvalued in an environment like that, and I would contend they possibly are. So the question we have to ask ourselves is, have we entered a kind of feedback loop where the rate cuts that we've already engineered have created high levels of valuation that then need to be supported with subsequent low rates? That's a question we have to ask. And I think there's a lot of evidence that markets may be stretched right now, number one. Number two, at a minimum, those market participants that are engaged in investing in these markets, so not the borrowers that are looking for low rates, the demanders of financial capital, as it were, but the suppliers of financial capital, the savers of the world, the institutional investors like endowments and pension funds, or individuals like your household 401k, these rates of return that we're going to receive in a very, very low interest rate or negative interest rate environment are frustratingly small. And all institutions, and every household too, ought to significantly mark down the kinds of expected returns that you would anticipate for a long-run investment horizon. And that is frightening, because it's going to be much, much harder to satisfy the needs of our long-run liabilities for each of us individually. That's your retirement. So that's one issue. Secondly, it is also possibly the case that these institutional investors, facing low interest rate environments for their safe assets, then are sort of forced or incentivized to move in and take on riskier positions than they otherwise would. So now you're going to sort of what we call reach for yield and take on a risk exposure that you might not have if those safer assets could deliver a kind of return that would be commensurate with your long-run objectives. So that's an issue, because that may not be costly in certain states of the world, in certain problems like an economic downturn. We don't know what that looks like. What we can say is that firms have significantly changed their behavior in terms of capital raising, right? So the guys that see that there's this appetite among a lot of investors for somewhat riskier issues, what we see now is a very interesting development in the bond market, where there is a lot of bond activity that sits right at the threshold between investment and speculative grade, much more than we would normally see. There's an appetite for buying these kinds of instruments, but what does that kind of piling up of debt right at that threshold that could easily fall itself into the speculative grade, what does that look like through an economic cycle? We don't know. And there are all kinds of examples like this in the debt market, with unusual debt arrangements that we haven't seen in the past. And what those look like through a downturn, through a cycle, that's untested. And then finally, I would say this, at least here in the United States, and I think you could make a similar argument outside, governments don't have to make tough decisions. They haven't had to make tough decisions for years. And we've had the luxury, I would contend, of sort of vacuously arguing about relatively little, while actually doing very little in terms of actual policy, because we haven't had to face financial constraints. The borrowing costs for governments around the world are so phenomenally low or even negative that you are able effectively to continue on kicking the can down the road along all kinds of dimensions that's pretty problematic. And so we don't know what this looks like over the long run. I mean, is it possible that low or even negative interest rates become a kind of trap? Now, politicians like them, particularly as elections are looming, we know that. Financial market participants like them because it elevates the valuations of the markets in which they're trading, and I would contend they may even be addicted to that. And households, borrowers, they obviously like them because they don't have to make as many hard decisions, and I would say that's a good characterization of the US government right now. But the issue is where the central banks are kind of stuck in a weird feedback loop where they have to continue to satisfy the needs of these various constituencies at the expense of the long run. And we just don't know what that's going to be because we've never done this before. So whether it's negative interest rates, low interest rates, I think it's time for us to ask some bigger questions. Is this working? I mean, is it really the case that the intended consequences, engineering some economic activity that we otherwise wouldn't have had, are those materializing? Or on the flip side, are we seeing some unintended consequences as possibly risky? Are there significant long-run costs of this kind of pervasive low interest rate behavior that is getting in the way of the allocation of scarce resources? Or in intelligent risk-taking, the kinds of avenues that are critical to a long-run success of the US and the global economy? And the reality is this is all uncharted water. Books will be written decades from now that can pick apart and sort all of this out. But unfortunately, we have to live in the here and now. And the reality is I am deeply skeptical that this kind of long-run interest rate environment is working as intended.